Hey y'all, it's CJ here. Welcome back to my channel. And today we'll be discussing some of the stocks from this article that they consider long-term stocks to buy now and hold forever. And I'm just kind of give you my thoughts on it and my take on that and if I like them or not. But 7 long-term stocks to buy now and hold forever. Finding long-term stocks to buy now and hold forever certainly sounds like a good idea. Sure, many investors often hear that no one can time the market, and I think this sentiment is more than true now than ever. Timing the market beats timing the market, and those with the long-term investing ambitions often do better by doing absolutely nothing than by looking to time the durations of the market. I agree. Of course, that's easier said than done. We all like to try and time the bottom or sell the top. I've been there and I've done that. However, those looking to put some fresh capital to work right now may find themselves in a difficult spot. That's because valuations are still high. Despite recent stock price declines among many big winners in recent years, the question many investors have right now, where to focus one's energy. Is it better to buy beaten up growth stocks with the hopes that the market doesn't end up in a long-term bear market for tech? Or are safe defensive stocks a better buy, despite the fact that many of these companies have actually seen the valuation expands of late? It's a difficult time. However, here's a mix of stocks I think are worth a buy and hold strategy over the long term. Each of these companies are reasonably valued and have meaningful long-term upside relative to their peers. So, Enbridge, ENB, Alphabet, Google, Berkshire Hathaway, BRK, Microsoft, MSFT, Home Depot, HD, Shermin Williams, SHW, Abbott Laboratories, ABT. So of these, I own Google, Microsoft, and I'm thinking about adding Home Depot to my dividends portfolio. So Enbridge is one of the North America's biggest midstream organizations, which operates a massive pipeline network that transport gas and oil, thereby keeping the U.S. and Canada warm and powered. This Calgary-based multinational organization pays a whopping dividend yield of about 6.3%. Of course, yield isn't everything. That's true. But it's a solid base to build upon for investors who believe this yield will remain stable. Even modest capital appreciation is likely to result in double-digit annual returns. In these kinds of markets, aiming for modest returns is a good thing. Now there are many investors who take the view that these higher oil prices are unsustainable. However, Enbridge's model is less tethered to the price of oil relative to its producing counterparts. As a pipeline operator, Enbridge receives relatively consistent payments which are reliable and grow alongside volume growth. Those looking for the defensive long-term buying opportunity with the potential to provide double-digit returns may want to consider Enbridge right now. So, Google, Alphabet. On the other end of the spectrum, we have Alphabet, a top growth stock for decades. Alphabet's core Google business is arguably one of the best businesses from a long-term growth perspective, as well as from a durable competitive advantage perspective. Alphabet has all but cornered the market for corporate and spending in the search space. Accordingly, this company simply prints cash each and every quarter in increasing amounts. This company has nearly $140 billion in cash and cash equivalents on its balance sheet, with only $14 billion in debt. That's a pretty good cash to debt ratio, if y'all look for that. But that's very important when you're looking at a company. As Alphabet continues to grow its top and bottom lines, this high margin business is likely to add even more cash to its hoard, all while providing more in the way of share buybacks for investors. While Alphabet doesn't pay dividends, this company does invest heavily in its other growth businesses. YouTube is starting to materially affect the company's bottom line, and the company's cloud business and another key area of growth many investors are watching. Over the long term, Alphabet's core businesses remain world-class growth opportunities for investors to jump on right now. Top long-term stocks: Berkshire Hathaway. Perhaps my favorite company of all time, mostly due to its CEO, Berkshire Hathaway is a conglomerate that is nothing short of impressive. Like many others, I can't wait to read Warren Buffett's annual letter, which was the shortest it's been in a very long time, regrettably. However, it's Berkshire's fundamentals and core businesses that most long-term investors stick around for. The company owns and operates a number of entities outright while owning pieces of a number of the other world-class companies as well. Among Berkshire's largest holdings is Apple, a company I think is a great long-term hold. Those buying Berkshire are essentially getting 40% of their exposure in the form of Apple, something I like in this environment. Overall, the core businesses, while Berkshire portfolio comprise a stable of solid long-term defensive growth companies. Those looking for diversification and long-term modest capital appreciation can't go wrong owning this gem. I agree. I thought about earning Berkshire Hathaway, but I own the Vanguard ETF instead. Like, a big portion of my exposure is in Apple as well, and we own a lot of the same. Actually, I think I do. I own Berkshire Hathaway through VU, I think, if I'm not mistaken. But the next company is Microsoft, MSFT. That's another company. That's the largest company that I own through the ETF. So back to the tech space, Microsoft remains a top pick of mine for those with a long-term growth orientation. This company was a third of its kind to reach the 1 trillion market capitalization level back in 2019. Since then, Microsoft stock has more than doubled, now trading at a valuation of 2.25 trillion. There are many reasons for this. Microsoft is one of the leaders in growing the cloud and infrastructure business. Today, this business provides much of the growth Microsoft enjoys, with a strong earnings base driven by the company's Windows and software businesses. Microsoft is certainly a company that can be categorized as a defensive growth stock. Interestingly, Microsoft is one of the few mega-cap tech names that pay a dividend and has for a very long time. While the yield is small, those who bought in a decade ago would now be enjoying an annual yield of nearly 10%. Accordingly, Microsoft is a top stock I think anyone can buy and hold for the very long term, despite its incredible rise of late. Top long-term stocks: Home Depot HD. Most home owners have been forced to deal with those nagging problems around the house during the pandemic. As we all clustered at home, folks everywhere sought out their local Home Depot for supplies, something that has taken HD stock on an incredible ride since the onset of the pandemic. In home and garden retail department, Home Depot is in a class of its own. This company's giant store footprint, product selection, and brand power go unmatched. In fact, many think of Home Depot in a similar way to Amazon in terms of the moat around this company's business. Home Depot's stock price has taken a hit of late as the valuation multiplies multiples have come down due to the macro headwinds. However, those looking for the long-term growth stories out to like how this company is positioned. Forecasts are for the home improvement market to hit $1 trillion in a few years' time, with Home Depot out to capture as much share as possible. Until folks stop fixing leaky sinks or planting gardens, this is a company worth considering. A 2.4% dividend yield is a cherry on top that I think further provides a floor underneath this stock, making HD stock a more defensive option to long-term hold. So I agree. I believe I did another video on that. I believe HD or Home Depot is undervalued right now. It's a defensive option. It's a great dividend to play where they're raising the dividend year over year. I think they've been raising the dividend for don't quote me on this, it's like 14 years or so. So they're on their way to becoming a dividend aristocrat, which is I think 25 years of increasing your dividends. So it's just a great overall company and stock to own, especially if you're a dividend investor. And I'm sure just about everybody has been to their stores. They're not going anywhere. They are a top player in their space, and it's just a good option. So the next stock is Shermin Williams, SHW. Let's stick with the home improvement space for a minute. Shermin Williams is an absolute behemoth when it comes to the paint market. This company sells over 1 in 4 paint cans in North America. This paint and coatings make products sell under 7 brand names in its name brand store network and retail stores. Be it a contractor engaged in commercial projects, a homeowner remodeling, or someone looking to put an annual coating on a deck, Shermin Williams is a top choice. This company's margins are impressive, and the company has been printing free cash flow for some time. Accordingly, Shermin Williams has not been afraid to share the love with growing shareholders. This company's small but growing dividend is another reason I look to this stock as a long-term buy and hold opportunity. In fact, Shermin Williams has posted 43 years of consecutive dividend increases, making its 0.8% yield seem out of whack. However, when one considers that the stock has increased over 85,000% over its lifetime, investors can see why this yield has remained low. Wow. That's a lot of percentage points. Alright, next company is Abbott Laboratories, ABT. Excuse me if I'm pronouncing some of these wrong. Is a healthcare company that many view as defensive. We all need healthcare, and until the existing healthcare model is radically changed, Abbott's business model is likely to remain a sturdy one. This company provides a range of medical devices, generic pharmaceuticals, and consumer products to the market. Over the last decade, this healthcare conglomerate retooled itself after spinning off a majority portion of its pharmaceutical business as AbbVie in 2013. The company's 2016 acquisitions of Alair for $5.8 billion and St. Jude Medical for $25 billion position this company well to focus on medical equipment for diagnostics, cardiovascular applications, and diabetes drugs. Like other companies on the list, Abbott pays a small but meaningful dividend, which may be to use to long-term investors in terms of total return over the long haul. I think Abbott provides interesting upside in its difficult to time market. Okay, that was pretty much this article. So my thoughts on this, like I explained before that I own Alphabet as well as Microsoft, and I agree with like a lot of the things that they're saying in this article. I haven't researched all of these companies like Abbott Laboratories, Well, at least some of these companies, like Shermin Williams. Like I've heard of it. I heard it's a pretty good dividend stock, a smaller paying dividend stock, but it's still a good one, consistent. And investing is not supposed to be fun. It's not really supposed to be fun. Like if you're looking for to get enjoyment out of it, that's not really the purpose. The purpose is to build wealth over time. And like they said in the article, it's more about time in the market and not more so not time in the market. So I believe these are some good options. Like I really love Microsoft. That's one of my favorite companies, not only because of the growth. I believe you're getting the best of both worlds with the dividend as well. They pay a decent dividend. They're in the tech space, and they have a $1 trillion market cap that's continuing to grow. I believe they have more growth in them than companies like Apple, and it's just a better option in my opinion. But I do own Apple through the ETF as well, and I think that's an awesome company. And I really don't have much of an opinion on Abbott Laboratories. I don't have really much exposure to the healthcare industry, and I don't research it as much. But they're saying that it's a defensive company. So I don't have much of an opinion on that. But this is a great article. I want y'all to check it out if y'all ever get a chance. It's by Chris MacDonald.